you mentioned Dodd-Frank earlier, which is the regulation that surrounds how banks are capitalized and their liquidity ratios and all this stuff to make sure that banks don't fail.
Right. It also gave rise to the Consumer Financial Protection Bureau,
Right, which
which is a
is,
behemoth these days. It's really making a lot
yes.
of changes throughout the whole industry.
And they're having some problems of their own, which could also be another podcast episode. That bureau is. But the banks, my point is, have a lot of regulations surrounding them. These online lenders have a lot less because DC is a slow moving city. They just haven't quite caught up with the times yet.
Sure, sure. And these lenders are subject to a lot of the same regulations, truth in lending, know your customer, even some of the securities laws, blue sky laws, the Securities Acts of 1933 and 1940. All these laws do apply and they are regulated, but it is kind of still the Wild West. The CFPB has not yet really truly turned their attention to Lending Club or On Deck or any of these other players. But I'll tell you, all of the bad headlines, this event last week, On Deck Capital had a pretty bad quarter. All of this stuff is drawing a lot of attention, and a lot of people in Washington are expecting um, the crosshairs to kind of move in a little bit more quickly than they would have otherwise.
Yeah.
So it's just yet another headwind that has to be overcome.
And one of the things that happened to the banks is when they instituted Dodd-Frank, a lot of smaller banks went out of business or were acquired by larger banks because they just couldn't keep up with the amount of money required to come up to par with federal regulation. So who
Sure.
knows what'll happen to these online lenders, especially because their balance sheets are very interesting when you look at them.
Sure. If their whole argument is that they have better economics than a traditional bank because they're online only, because there's fewer heads to pay salaries, fewer there's no branches that you have to pay rent or keep the lights on, that really brings into question if those economics are really there when you layer on some of these additional operating costs from having to do the same regulatory work that a $1 trillion or $100 billion bank has to do. So it's a big question mark.
Yeah, and I
And on the
know,
cost front too, this is probably a good time. I wanted to come back to marketing. Again, their argument is that their economics are better. They can make more money more efficiently because of this lower, overhead. However, when you look at their numbers, their customer acquisition costs are extremely high. Routinely, 35 to 45% of their revenue goes to marketing. And you might be thinking, well, yeah, they're spending a lot of money on marketing because they're trying to brand and do all these things they have to do. But tracking it over time, their marketing expense has been moving up in lockstep as their revenues have increased. So they're really not achieving any scale with consumers. That's problematic for them because it's a transactional model. They don't really have any way to kind of go back to the well. You get one customer, how can we expand that relationship? And again, clearly you can tell I'm in favor of traditional banks at this point in time on this because that's the biggest benefit of traditional banks is that relationship.
right.
Wells Fargo
And
was famous in the 80s. Their slogan was 8 is great, meaning for every customer they wanted to sell 8 products.
yeah, and that's something that they've actually achieved, which is great. Like,
It's amazing. Yeah. The best banks in the US, that's what they do. First Republic, over 7 accounts per new customer. You walk into the bank, most likely you're walking out with 7 accounts or more.
right.
That's
And
fantastic for
when
profits. That's fantastic for long-term wealth building. And it's something that at this point, I don't see how Lending Club or On Deck or some of these others are going to replicate. It just seems so transactional.
Right. And when we say accounts, it's not just loans, right? We're
Right.
talking credit cards, debit cards, savings accounts, all these
Wealth
types of things,
management,
wealth
checking
management.
accounts, savings accounts.
Exactly. So these are all things that these online lenders just can't do, not unless they decide to become a bank and then they're no longer what they were.
That's right. That's right. And that's what some of them are doing. Some of the smaller ones, they're actually going out and trying to buy community banks for that reason. And also, another advantage traditional banks have is their cost of funding. If you, I'm sure everyone listening and watching knows that if you go open a savings account today, the bank's really not going to pay you any interest on it, maybe a few basis points. That money's free money for the bank to go out and make loans and drive their yields higher. But on the online lending marketplace, that money is either going directly to some other person in a peer-to-peer at a really high yield, or it's going to some capital investor whose cost of funds might be 7, 8, 9% as opposed to 7, 8, 9 basis points. That's a huge advantage for traditional banks, and it's going to be really challenging, and it's going to be really interesting to see how these online lenders kind of overcome and try to manage that. I wouldn't be surprised if a lot of them end up with bank charters and accept deposits, just like some of the existing online only banks.